What a great guy to start the week off with. Mike, how are you? It's great to have you back. You're
I'm good. How are
unmuted over
you?
there. Good, man. So, I watched some of your videos.
Yeah,
Yeah, and you really cover a lot of things that people aren't looking at. You really look at beneath the surface stuff and a lot of things on swaps and
sure.
rates, and you go over all the news. And I saw something in one of your Twitter, I think a tweet about, or it was a video about how financial conditions are tightening or there's a liquidity drain
Right.
happening at this time. Can you tell us what you're seeing and
Yeah,
show us?
sure. I'll let me just share my
Because
screen.
it's certainly showing up in the gold market today. If
Yeah,
there's
it's
a
gonna start
liquid,
it's gonna start showing up in a big way in all the markets over the course of this week, I think.
okay.
So
You're looking for some hot numbers on the inflation numbers.
um that I'm not seeing anything that suggests that the inflation numbers are gonna be hot. Most of the data points I'm seeing are based on the swaps markets and based on some of the betting markets, are
Yeah.
that numbers are going to basically be in line. I mean, if you
Okay.
look at I think it's more about, where inflation is going to be going from here. And based on where the market is, we basically have inflation expected to rise to about 3.5% by the middle of next year. Um,
Okay.
and so this it's really more important, I think, from a standpoint of this number this week, is that these numbers don't surprise to the downside, right? If these numbers just come in line, then everything's kind of on target for where the market sees rates going, inflation going. Obviously, if they come in hot for some reason, um, then you're talking about the market probably upping its expectations on where inflation's going, and that would shift things, I think, in a more meaningful way. But I think over the course of the next couple of weeks, we're talking about the potential for, basically a draining of liquidity. And it was interesting because I saw the chart of Bitcoin as well over the weekend, and I saw it was going up, and I'm like, oh, like this is doesn't make any sense to me. But
Yeah.
essentially, with the passing of the debt ceiling, the Treasury now has to refill the Treasury General account to about $850 billion by the end of September. So the
Okay.
Treasury General account right now is this dark blue line down here, and it's sitting right below 500 billion. And that number's got to obviously rise another 350, 400 billion, depending upon how this takes place, to get us back up to this level in here. And historically speaking, when you look at changes in the Treasury General account, it tends to coincide with liquidity coming out of the equity markets. And you'll see that, stock market has tended to move lower during that periods of time. A lot of people are kind of under this impression that, maybe it doesn't matter, because in 2023, when the TGA was being refilled after the debt ceiling, it only had a partial impact, only about a 10% decline in the S&P 500 from it. Um, but I think what was important is kind of, an oversight, is that in 2023, at the same time, the TGA was refilling, we had the reverse repo activity coming down, and that was adding liquidity to the market. So if you take this number and you just invert it, if I can figure out how to, this is all new to me, so this is
Yeah.
a new product I'm using. But if you basically invert it, it will you'll see it basically. You see how it looks like the S&P 500 then?
Yeah.
So the difference between now and then is that the reverse repo facility, which is a number the Fed puts out every day at 115, is basically drained. There's no more excess liquidity in the marketplace.
Mike, there was a story about 3 weeks ago about someone having to go the window for this exact reason. and someone was saying, it had happened with this amount of size for many years.
Yeah, the
So
$11 billion.
was that so? Did that catch your attention too? And now with what you're seeing continuing to occur, is why you're kind of putting the yellow light out there, the caution light.
Yeah. So essentially, the reverse repo facility is an indicator for excess liquidity in the marketplace. And when the Fed pumped so much QE into the market, there was literally so much cash that people had no idea what to even do with it. And so they were basically just giving it back to the Fed. And in return, the Fed was giving them, was paying them for this. And they were paying them whatever the prevailing rate was basically in the market at that time, 5.5 or 5.25%. And as the Fed began to do QT, and Janet Yellen issued, whatever the trillions of dollars in treasury bills, that all began to drain, and that led to the reverse repo facility basically draining to where it is right now.
Yeah.
Now, the interesting thing is that repos and the Treasury General account are a liability on the Fed's balance sheet. So when the Fed's balance sheet is when the TGA and when reverse repo facilities are rising, they're draining liquidity out of the system because it's taking up balance sheet capacity, and banks don't have excess cash to lend out. And
Okay.
when the and basically this darker blue line here, and basically when you look at this blue line, you'll see that this blue line trades very well with the S&P. Now it's separated a little bit during this period of time because the reverse repo facility was draining, and it was keeping and basically helping to boost the equity markets as a lot of this liquidity came out. Uh, Essentially, banks had more margin to lend, and now you're at a point where the repo facility is basically drained. There's really no more money, there's no more excess liquidity in the system. And you're looking at a scenario where the TGA is going to rise back up into this area. And with no liquidity offset, reserve balances are going to start coming down again. And that should really drag, equity prices down with it as banks have to pull back on that.
So
On
they have to raise cash by selling equities.
Well, I mean, they have to raise cash by doing something. I mean,
Okay.
we live in a world where you have three options to basically go and raise cash, right? You can sell equities or you can sell bonds. But the thought process is that if the Treasury is going to issue $1 trillion worth of Treasury bills, that money needs to come from somewhere to fund that. That you know that needs to be funded somehow, and that cash needs to come from somewhere. The question is, where is it going to come from? And
Yeah.
with no more reverse repo facility to drain, my thought process is that this is going to show up in the form of tighter liquidity and higher repo rates, and that's going to be a drain on equity prices. And so you can watch basically repo by just looking at what the SOFR rate is every day. And the SOFR rate, if it's rising, indicates that the overnight rates to finance and borrow are getting more expensive. And when it's getting more expensive, it's an indication of liquidity getting sucked out of the system.
Okay, Mike, could this also have impact on what's happening with the dollar? We put in a low a few weeks ago, had a nice pop. It's pulling back in here. Does a dollar shortage play into this? And with what sovereigns have to do to raise money, do we have a crowding out kind of situation with
You know,
the Fed dominating, the Treasury dominating the need for
I
funding?
mean, it's possible. I mean, this is a Swiss franc US dollar 5-year cross currency basis swap spread. And I mean, you can see that when it's rising, it's a sign of easing dollar liquidity.
Yeah.
basically, excess liquidity in the system. You can see more recently this started to turn and things are starting to tighten. I mean, they're still very loose,
Yeah.
and you're still far from where you were in late 22 and 23. But what
Yeah.
it's
Really.
showing you is that the dollar funding is getting a little bit tighter, a little more expensive. And you're really seeing that across, multiple types of currency pairs. This is the euro. It hasn't really recovered at all
Right.
since early March. And this is the yen. And that also is, showing some signs. Oh, that's the forward rate. Sorry. And this
So
is the
last August it was a yen carry trade unwind, and you're
that
talking
was
about we're talking about thin market conditions where bear raids can be very successful, and
right.
maybe this August it's a repo scare that a lot of people have to go to the discount window.
Yeah,
Is
so
that
I mean,
what banks
basically,
go?
yeah, basically what I'm thinking is that this year going into the end of September, between now and the end of September, we could see, a decent amount of liquidity sucked out of the system due to the Treasury refunding and refilling its general Treasury account. And this was the spike you're talking about.
Yeah, right.
And this was in the repo facility at the Fed. So the Fed has two different facilities: the reverse repo facility, where the Fed takes cash and in return pays an overnight rate. And then you have the standing repo facility, which is basically where the Fed is taking collateral and giving back cash. And so when there's a liquidity shortage and the overnight funding rate goes over 4.5%, an institution has the ability to go to the Fed standing repo facility and get excess cash for overnight, and then the next day return that cash to fund whatever operations they need. So,
They don't like to do that though because they're paying a higher rate, and isn't there a stigma
no,
a bit?
I
No?
don't. I don't really know if there's a stigma. I think you're thinking about the discount window, which is a little bit different than this.
Okay. All right.
This isn't. I mean, the discount window. First of all, well, we don't really know those details all right away, but you can see that the standing repo facility hasn't really been used in a very long time.
Yeah.
And essentially, the idea is yes, you're paying a higher rate, but the idea here is that so that you don't have like those 2019 type of issues where the repo rates were going all over the place. In theory, if there's a shortage of cash, they should be coming to this window, this operation, to be able to get that cash to fund whatever it is they need. But more importantly is that once you start seeing activity and it's really starting to increase, that's really an indication of, liquidity strains taking place in the market. Um,
Any way for you and I to get in line in front of that window?
no, it's not open to ordinary people like us. Only
what
primary dealers
what
and
what
large hedge
what
funds.
what a high compliment. We're ordinary.
Right,
Okay.
exactly. Well, I mean,
Anyway,
you can watch all this stuff. I mean, the repo facility prints at 115 every day, and the standing repo
yeah.
facility is at 145 every day.
So what's actionable about all of this? You'd be lightening up on long
Well,
positions
I would
in.
say, I mean, I would say that I'm not antsy to buy anything in stocks at this point.
Okay.
Um, I'm more than happy to kind of just see you know, see the market cap weighted index, which has just really become Nvidia at this point. It seems like, you
Yeah.
know, go without me. I'm not buying anything new at this point,
Okay.
unless it's sort of outside of the really, high flying. If it's like I would say that I'm looking for things that are more defensive at this point. And if it's something that's more defensive and valuation really makes sense and the chart looks decent, then that's different than I think chasing some of these high flying tech stocks that have you really have seen, go crazy.
How about any duration in bonds that would or would you be an avoider of
I'm sort of
all
a
bonds?
well, I don't really ever buy bonds, but I mean, I certainly, what I'm writing about and talking about with, in my subscription services and write-ups that are public is that I think rates on the back of the curve can go higher still.
Okay.
And I think that ultimately, I think the long end probably isn't really a great place to be. I use like a stock like Wingstop a lot of times as like a liquidity gauge, and it sounds kind of silly, but this stock, I mean, it just really seems to always be.
You know that I had wings 5 nights in a row last week?
Oh,
It's
did you?
amazing you bring that up.
But if you
Uh,
look at the stock and you compare it to Nvidia, I mean, it has like this weird, you know, look to it that, there's
yeah,
just something about it to me that every time I start watching this thing going up, it's sort of leading the charge. And when it's coming down, it's leading the charge. If it would probably be lower if it wasn't for the fact they reported earnings and the stock went up like 26% in a day, but you can see it's given
yeah,
back a lot of it.
yeah.
So
Wingstop. Oh, really, that's interesting. Uh,
yeah, I think it's just more of a sentiment trade.
consumer,
Yeah.
consumers still going out and spending. You spend what, about $2 a wing at a restaurant.
Yeah, I guess.
So anyway, there is Wings Wednesday here on Highway 101
Okay.
in Encinitas if you want to meet me. Anyway,
West
boy,
Coast.
I'm hungry now, Mike. So, all right, so you wouldn't want to buy stocks.
No.
Anything, is this an environment to spec short against the highs at 440? Or do you think we have a new high coming in SPX?
And the SPX, I mean,
Yeah.
you mean 640.
Six, no, 440 is a high. From last week, we had that key reversal,
Oh,
and now
oh,
we're all the way back to it
you're talking
right in
about,
here.
okay.
Yeah.
Okay.
Yeah. If we
Um,
take that high out, yeah, then you are talking probably 66.30.
yeah, I mean, uh, the thing is about last week, which I thought was odd, was that when you look at this, you have this bearish engulfing candle on the
Yeah.
weekly.
Yeah. Yeah.
And most of the time when you get these bearish engulfing candles on the weekly, they're pretty good. I mean, here, I mean, they trading view does it for you. You don't even need to do anything. I mean, here's a bearish engulfing pattern. It
Yeah.
worked. This time it
That was big.
didn't work, and we ended up getting another one. This one worked. This one worked. This one worked. This one worked. This one. I mean, this one didn't work, but I mean, the majority of them have tended to work. And so I was really surprised that the market, that they were able to take it up last week at
Yeah.
all. Um,
I look at
Obviously,
while you had that chart crunched up a little bit, Mike. Take a look at the downtrend in the RSI. So compress it again like you had it before.
oh,
All right, so the high in the RSI looks like it happened right after that's the high. And when was that? That's in March. Yeah, gosh,
it's March of 24.
that's a pretty long-term divergence.
Yes, it is. And I mean, we got, a lot of people will tell you though that you don't usually get two big sell-offs in the same year. Maybe,
Yeah,
I guess. I mean, we don't have to go back to the lows, I guess, but yeah, no, it's a pretty big long-term divergence. And even when you look at it, it's on the weekly chart, and even when you look
same.
at it on the monthly chart, I mean,
Yeah, same.
you can make the same kind of argument. That's
Yeah,
back in 2018.
yeah,
So, the market's been, I think the market that's why I think the liquidity piece matters so much because, if you look at, the latest FINRA data, a lot of the reason why we went up was because of, margin rates. I think margin increased to over $1 trillion, which isn't a huge
mhm,
number when you think about the percentage of the market cap of the S&P, but it kind of tells you that a lot of what we've been seeing taking place is really due to the increased amount of liquidity in the marketplace and not so much um, anything else, I think, because I feel like a lot of what we're seeing is also taking place in the options market through zero DTE and things of that nature.
Yeah.
So, the question becomes, if liquidity starts coming out, does that really start having a meaningful impact on, where price goes? And I think historically it shows you that it does. And, with multiples back to kind of really high levels, it really creates an argument for potentially lower stock prices. I mean, that's really the hard part that you kind of come across, and you kind of um left with trying to understand. I did this chart last night that I wanted to see if I can pull up and show you. Oh, here. So this is the margins in the S&P, but I'll get rid of
Okay.
this for a second. But if you
That's pretty. Yeah.
look at the P ratio, and then you look at the averages, you see that we're back to the highs on the P's.
Right.
And if you go back to, 1999, 2000, it got up to 24 and a half. So, I mean, at 24 and a half, the S&P would have to get to 7,000 for that number to work.
That's where I think it's going eventually. But I don't you think if we do get a correction, Mike, do you think it's be garden variety 5 to 7%? Take us back to 6140, the old
Um,
previous all-time high, or a little,
I
or
think
would it
it
be
could be a
deeper?
little bit, I think it could be
Deeper.
a little bit deeper
Okay.
when you look at it from a technical standpoint, because,
Maybe go for some of the gaps it has underneath the
yeah,
market.
like, I mean, there's a gap here at 6,000, but I think
Yeah.
this is the one that I would be looking for
Yeah. 56,
more
57.
so, because I think that lines up with, here.
Halfway back.
Yeah.
Yeah. That'd be a great buy down there for a move to 7,000.
But what I want to show you was this, because what's happening here is that, in 2000s, you were getting 17, 18% earnings growth, right?
Yeah.
In 2022, 21 rather, you're getting 22% earnings growth. This year, you're only getting 12. So you're
Yeah.
paying the same multiple for lower growth. And so all this, crap about how, we're getting all this growth out of Nvidia and blah, 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 blah. I mean, we're getting really below average growth rates, and you're
Yeah.
paying an above average multiple. And so I don't,
Is AI starting to feel like .com to you?
yeah, but it feels a little bit scarier because this involves, I mean, they're spending so much money on this stuff that I almost feel like they're spending so much, you better hope it works.
Okay.
And the thing is
And
that,
it's who is it going to work for?
well, that's
I
the
don't think
question, is
it's
who's
not.
going to
Yeah,
work
it's
for.
not. I don't see it working for the average working American
Well,
at all. They'll be displaced.
right, but I think the other thing is, I use like Chat GTP, I use Gemini, I don't use Perplexity anymore because I don't think it's very good. Um, but I can't really tell the difference for most tasks I use it for.
Yeah.
Um, and so what makes a product worth what it's worth if you can't really tell the difference between, two different products? And so, if Gemini and Chat GTP are essentially, let's say, a very comparable product, are you really, if Chat GTP is $100 more a month than Gemini, and you really can't distinguish the difference between the two, why would you use Chat GTP? And so if you're plowing all this money into something, and it basically, it becomes commoditized like every
Yeah.
other technology, then
Right.
you've just wasted, all this money. And what's really kind of, I guess, what I wonder about is, Meta has burned through tons of cash, and now they just had to tap the debt markets for like 29 billion to basically
That's
fund their next
interesting.
data center project. So
Yeah,
anyway,
because they were so cash rich. I mean, have they stopped their buybacks?
no, not that I'm aware of. I mean, they
All
only have
right.
like, I say
So they'd
only
rather go the
like
debt
12 billion.
market. They'd rather go the debt market instead of stopping buybacks. What's that make you think?
It makes me think they're really gambling on the future.
Yeah, I tell you what, Michael, it's always fascinating to have a talk with you, and I encourage people to go to your YouTube channel, check out your reports. They're outstanding.
Thank you.
And what's the best way for people to get in touch with you that are
Um,
interested in, hanging out with,
so
a smart guy?
I have a Substack called Navigating the Market. And then I publish on Seeking Alpha website under Mott Capital Management, and I have a subscription service there called Reading the Markets. And then I'm on Twitter under Michael Mott CM, and on YouTube as well.
Okay, Mike, are you accepting managed funds from people?
I run a so what I do is I have an agreement with Interactive Brokers,
Okay,
and so if people like my investment strategy, they could invest in the Interactive Broker advisor platform where my strategy is available. And basically, every time I make a change to my portfolio, it basically copies over. I make the change in my portfolio there, and then it copies over all the accounts that are associated with me.
okay. Costs involved for that? Is it like, most
I think
people get two
they
two
charge
percent?
75 basis points per
Yeah,
year.
that's cheap. That's cheap. Okay, because a lot
Yeah.
of people, they're 2 and 20 and
Yeah, no,
stuff like
I don't run on
a hedge fund.
performance base. I just do flat
Yeah.
management fee.
Oh, okay. Well, check Michael out. I don't think he'll get caught next year in the bear. I think doesn't it feel like we still have some time to go in this bull market after this big run from April? Just doesn't seem like it. We could turn the battleship around without some distribution taking place.
Um, yeah, I'm not sure about that.
Okay,
I
so
mean,
maybe they've even got me where
yeah,
back.
I'm just not sure about that. If
Okay,
my thesis is correct, it's going to probably happen a little sooner than later.
okay. So that's what I'm thinking. One good cleanse, and then one more melt up, and then it's over. But
Right.
man plans and God laughs.
Yeah, I think it depends on your time horizon, maybe.
Yeah. All right, buddy. Well, great talking to you, Mike, and I hope you have a great, the rest of the summer is good for you and your people, and we'll get back together in the fall
Yeah,
and
sounds
see
good.
what's happening.
Looking
Appreciate
forward
you
to that.
coming in. Appreciate you coming in and sharing your, hard-earned insights with us.
Thank
Thank
you.
you.
Not a problem. Bye.
All right. All right. Mike Kramer, everybody. Follow him on X at Michael Mott CM. And Mike is a pretty sharp guy. So that's going to be a wrap for me, everybody. Okay. You can join the team in 14 minutes on the morning edge. And remember, don't just count your pips, count your blessings. See everyone for Turnaround Tuesday. And the gold break was caused by the full moon. Okay. Blame it on the moon. Okay. We'll see. Maybe we're going to have some successive topping action. And maybe we get hit in S&Ps this week too. All right. Take it easy, everyone. Adios. You're welcome, AJ, Laura, Saloom. Thank you. Oh, Saloom, people that have retired are about to retire aren't shorting the market to blow out their retirement accounts. I don't know where your source is, but they they're long. People people don't short the market. We're a minority of people out here that trade both sides of the market. So most retirees um, hope you're right. And I hope they know when to get out, because there will be a time, as there always is. Adios, everyone.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.